Good day, everyone. Well, this will be an incredibly important video for you to watch and will completely change the way many of you view the market and trading. I know this because for years I've helped thousands of traders develop their skills and go from knowing nothing to becoming consistently profitable traders. And I know the types of things that end up being major breakthroughs for people, a perspective shift that they have that completely changes how they view the market, how they view trading, and is sort of the missing puzzle piece. So my idea with this video was, how do I cover these concepts in a way that we can break them down concisely but in depth? And what I decided to do is to take some trades, live trades, with a paper trading account on TradingView. So I have all my analysis here. We can just look at it all in one place. And these are just trades I've taken in the Discord since yesterday. And I'll use these trades to break down these concepts that are so important that you will not be a profitable trader, a consistently profitable trader, if you don't understand them. And whether you think you do or you think you don't, likely you don't, just based on the interactions I have on Twitter. Most of you think you know these things, but by the types of things you say, you clearly don't understand them. All right. So here's what we're going to do. I have 3 setups we're going to cover. And each setup we're going to cover kind of a different concept. I've started this paper trading account with $200. Okay, so this is yesterday. We're going to go over 3 positions. I'm not risking any more than 2% per trade. This is the first thing that needs to be understood. There's 2% risk per trade. We're going to cover different trades, different stop losses, different invalidation. But every trade is going to be a $4 risk, which is 2% on a $200 account. We're already up to $232 on the account, risking no more than 2% per account, if we realize all these profits, which we haven't yet. Okay, so we're going to start with trade 1. I'm going to talk about the structure of that trade. And in this, we're going to break down the concepts that are so important. It's not just technical analysis. It's about structuring your trades well, and structuring them in a way that makes sense mathematically with good risk management. There's so many people who will say things like, oh, I have a small trading account, or it's not worth, joining the LATF because, it's $97 a month. With a $200 trading account with 3 trades that are nowhere near their targets, I'm at $232 after 10 hours. 3 trades. One I took profits on for $5. This is I'll explain this in a second. There's $4 of profits here that aren't actually realized yet, but ultimately we're at $232 in profits, $30 of profits on a $200 account in one day. All right, so I'm not saying that this is how you guys should expect to perform if you join the LATF on day 1. These are just trades I've taken in the Discord. But what I am saying is that the emphasis should be on learning. Developing these skills is so much more important than the dollars that you may or may not make when you first start off trading. You're not going to make anything if you don't learn this stuff. But these simple trades, even with a $200 account and risking no more than 2% per trade, we're already up $30 on a $200 account in 10 hours. So you think over the course of a month, there's certainly that potential. Okay, so we're going to start off with this trade. All of you should be familiar with this. I've talked about it so many times on Twitter, in the Discord, and here was the idea. Pushing up into this POC, I talked about this idea way down here. Pushing up into here, looking for this short setup, might be able to trade with the very tight invalidation. Price pushes up, I take that short. So this is trade 1. This is, but price ranged here for a little bit. So anyways, talking about levels to the downside, I gave 3 short ideas here. But if you missed the initial sweep, I just pointed out that you could also enter on the retest. So we sweep, we retest. This is a valid entry. So this was the next day. So we range here for a day. You could also short here. Plenty of opportunity to get into short with clear invalidation. And we're going to talk about this structure, how to structure this trade in a moment. And I just pointed out it's the exact same style and system of setup as this so long where we rallied 35% with the sweep and the retest. It's just a short instead of a long. All right, so it's important for me to break down these concepts every single day in the Discord, or every day I'm actively trading, which is almost every single day. It's all based on the stuff I teach in the alpha videos when you become a member, and in these alpha slides, which is almost like reading through a book in a sense, but there's questions, charts, all these things. But it's not enough to go back and talk about concepts in hindsight. Like I'm doing now, I want to talk about these ideas and identify them on live charts. So that's what my live updates are. I'm talking about the positions I'm taking, the reasons why, explaining, hey, this is this concept in this video, or this concept from this resource live in the market right now, and I'm taking a trade based on it. This is where I'm entering, this is why I'm entering, this is my validation, these are my targets. All right, so anyways, that's trade one. So as price comes up to take these highs, what's the setup? Again, if you're following me on Twitter and you're watching this video as I post it, I've been talking about this setup since way down here. I had exactly this drawn out, right? Pushing up into the POC as a short target. So why am I shorting up here? We're going to talk about this setup after, but this is the first short we're talking about. I take the short, my stop loss above the high. You can see here, when I enter the short, my stop loss is 0.6% away from my entry. I took the short a little differently on the paper trading account because I didn't have the idea to trade this way and do the video this way with a paper trading account on TradingView until after I took my initial entry on whatever. But it's the same basic premise, shorting this key level. My stop loss is up here above this level at 43,958. You can see the risk in here is $4, which is 2% of a trading account. If I move my stop way up here, it would go to $12. That's too much. So what's the idea? Well, I have the retest here. I want to have a $4 loss, so my sizing dictates this position. Sorry, my invalidation, which is a sweep of the size. So we've grabbed the liquidity. We're breaking down. My invalidation's up here, just above this high, $4 lost. I'm at $17 in profits right now. If my swing target gets hit, this is an ambitious target. There are very few levels I would trade this deeply, but this is one of them. I'm okay to either get stopped out, and I could even capture some profits. I could take the risk out. I could take $4 off, put my stop to even, and it's a quote-unquote free trade. But if I reach target, I make $102. On a $200 trading account, I've risked $4 to make $102. And so this is where we talk about risk-reward, the risk-reward ratio here. Here it's 26 to 1. For every dollar I risk, I make $26. That is why I make $102, risking $4. Now, of course, where people go wrong is they just risk way too much, and their account can't handle a sequence of losses. We're going to talk about this a little bit more as the video goes on. So this is the first trade. If I closed it now, I'd make $16. I see no reason to close it now. The trade's working. You know, I see no reason to take profits. Price is continuing to see lower. I'm not expecting price to go straight to the target if we reach it. Maybe we get something like this. You know, maybe we come down here. Maybe we come back up. I have plenty of opportunities to take profits, but I also have plenty of opportunities to take other trades and just leave this as a separate trade. So that's what we're going to talk about in a second. I'm going to talk about one more trade, and that's this say trade. So I took this yesterday. Again, these are very simple trades. They might not feel simple to you, but I can assure you they are. And I've closed this trade. And so I'm going to just show you that, okay? So we're going to go here. This is the alt trades update. Wait, what the? Oh yeah, here it is. Okay, and again, this isn't even counting. I took a long down here looking for this push up primary target up here on Sol. This was like a massive, massive move. Look, Sol long, massive move from $82 up to 110. We're not even covering those. You know, these wins pile on top of each other. We're talking 10R, 15R, 20R, 15R, 10R, and that's going to be relevant in a moment. But yesterday, I take this say trade. I say I want to short this ascending channel. GP slightly front run. This is just a technical level, but willing to put on a little bit of risk. when I say put on risk, I mean I'm exposing myself to the market, but doing it reasonably. And then we just have a straight breakdown. Now again, I took this trade slightly differently on the paper trading account because of just the timing of it. But this was the basic setup, short. And what I did was I closed this position. My target was down here. I closed it on a bit of a rally. And I made $6 on that trade off of... I think on this trade I took $2 of risk or $1 of risk. So what 1%? But anyways, this is the one trade that I've closed. That's where the profits come from. Again, just taking reasonable trades, reasonable risk. I had a wider stop and a smaller size. And now that I'm making this, going over this video, because I started trying to make this once and I forgot to switch my screen from Discord, which is something I'm gonna have to explain briefly in a second, why something looks different here. But this is a reasonable trade. I've locked in $6 of profits. You know, for a lot of traders, and there's nothing wrong with this, making 5 or 6% a month is great. And if you can do that consistently, you're going to build up a trading account very quickly because of the power of compounding gains. But anyways, this is the say trade. So I just want to cover, because I took 3 trades. These are the only 3 trades I've taken. And then I took this short, okay? So this was a compounding position, and it looked like this. Entry here with a very tight stop loss above these highs. Now it looked a little bit different on this chart. I had to use 2 different charts because TradingView does not let you paper trade this way. You have to trade on different pairings, so I have to be on 2 different charts. But to compound it, then I took this short, and it was a retest of this level. So let me just go into this. And we're going to get into the nuts and bolts here, but let's establish what these 3 positions are. All right. So this morning, I went to bed after I said, good night, traders. You know, there was so many opportunities to get into this short. I'm going to bed. We have the retest, we have the rejection, the POC, the big key level here, looking at that from 10% lower and trading it. In the morning, price is broken down even further, and I say, look, we have this SR support resistance flip on bearish order flow. I'm not going to explain what that is in this video. That's not the point. I said, this is a reasonable short. To short with invalidation above this high, this short is a 0.2% stop loss, all right? I go through and I give some examples of the benefit of running a tight stop versus a wider stop. Both are okay. Sometimes you have choppy SR flips. Sometimes they can be very clean. This is just an old chart, just showing examples, again, to cement those ideas in people's head. And just saying that, you know, price could easily reject and then come and sweep this high into this level. This is still very possible. But just saying that this is a nice opportunity to compound this trade, because look at the risk reward on a setup like this. If we get a clean retest and rejection, it's 20 to 1. For every dollar I risk, I make $20. So this trade does not have to win very often for this compound onto my shorts for it to be a profitable trade. And so what that means in a systemized setting with your trading is that you take the same type of trade over and over and over and over again. It pays you more than you lose when you lose, and you take reasonable asymmetric risk. Or put yourself in an asymmetric risk reward situation. So this trade already is running at it peaked at like 6R. It's an incredible trade. That means for every dollar I'm risking, I'm making $6. Here we can potentially see a reclaim, and there could be an argument for just taking profits off this trade if we reclaim this. A 3.3R win in a day is incredible. Okay, that's making $13 on $4 risk in the morning, right? That's amazing. Anyways, so this is this setup. The reason when you're structuring it this way, and the reason that my entry here on the paper trading account is all wonky, is if we go into here, what we'll see is I was making a video on this and I forgot to switch back from Discord, so you couldn't see anything, so I have to remake it. But I captured $2 of profits, $1 of profits. I was opening and closing this position to show how different ways that you could size it. So let's just do that now. I'm going to close. I'm going to capture this extra $3 in profit. So now between all my positions, I only have one open. That's swing long at $15 of profit, and I've captured $13 of profit. So if I have my stop loss set to entry now on here, what does that mean? That means if this position gets stopped out, I'm going to lose this $15 of unrealized profit, and I'm going to be up $13 on this $200 trading account in the first 10 to 12 hours of trading. Not too bad. Just taking reasonable setups, not risking any more than 2% per trade. Now, let's just say I want to try to short this SR flip. This is where we're going to get into, although I don't, but I'm going to do it. I'd rather wait for a better trigger here. But anyways, this is what I want to do. I want to trade my setup like this. And I want to risk, again, 2% here. So how does that look? Well, this is my invalidation, 43096. So let's go stop loss, 43096. I want my risk to be 2%. So this gives me a new size, and that size is 0.0101. Okay. So I'm going to market sell, and we can see here it's 4.5 because my account's grown a little bit. $4.5 is my stop loss. And if I hit my target, let me just add this in here for continuity's sake, 41329. Take profit, 41329. I'm risking $4.5 to make 13.29 if this downtrend continues. That seems pretty reasonable to me. I don't quite like this entry as much without a little bit more weakness even, but this is the basic concept. But let's just say that I want to trade this wider. I say, well, I want to enter now. Again, we're not talking about the logic. We're just talking about the trade structure, because I think price could come up here, but I also want to be a part of this move if we don't, and I want my stop to account for that. Well, what would this setup look like? Well, we're approaching a 1R setup, essentially. There's nothing inherently wrong about a 1R setup. Let me close this position. And I'm going to explain what that means in a second. But it basically means for every dollar you risk, you make a dollar. Now, I prefer setups that have asymmetric risk reward and a high win rate. If I can make 10 to 1 with even a 30% win rate is incredible. The higher you can get your win rate, though, if you can get to high risk reward setups with high win rates, I mean, that's when you become an elite trader, right? But there's nothing wrong with this setup. Let's just say I want to take it. So let's explain the concept here. My stop loss is now up here at 43630. And this is the mathematical glue that holds any trading system together. I'm going to cover probabilities briefly at the end here, but let's talk about this. So I want 2% risk. Well, now my position size is way smaller, 0.0045, and we're going to notice something. My take profit is going to be here at 41320. I'm just kind of not randomizing this setup. I'm just kind of changing a little bit for the sake of the argument or the example. So we're risking $4.4 to make $5.9. And the question is, well, then what people don't understand when they see this, I can tell just because of the comments I get on Twitter, is this setup with entry here, stop here, entry here, stop here, or entry here, stop here on this initial setup, which, if you close this at the bottom here, that's a 6R trade, or even on just like there is a golden pocket here. I'm not going to get into that, but even here, this is a 3.6R trade. This setup makes more money than this setup. I've just made, I make more money shorting here, closing here, than I make shorting here, closing here, if this is my invalidation. So we have 3 examples here shorting with tight invalidation, shorting with wider invalidation, and shorting with very wide invalidation. How is it possible that all three of these shorts risk $4? Because the ratio of your risk to reward determines the profitability of the trade, but the distance to your stop loss determines your sizing. It's always, in this scenario, it's always 2%. It's always $4 risk, $4 risk, $4 risk. We don't care about where the stop loss is. I'm going to caveat that in a second, or where the target is. We care about the risk-reward ratio of the trade. Okay? So hopefully this is making sense. So now we have to ask ourselves, well, how do we know how to size our trade and where to invalidate? It depends on the setup. So some setups, like this one, let's just go to where this trade is. Some setups like this one can be traded tighter, like for example with the 0.06% stop loss and the very high risk reward where I make $100 for every, or for risking 4. But some setups cannot be traded that way, or should not be. And the reason is because trades need to have a technical structure to them with both their entry, targets, and invalidation. So why could I trade this setup so tight? Because this is a technical setup that I see all the time. We have a little local high here into the SR flip. And then we come up and retest that level. You can see it right here. A nice tight invalidation short on the SR flip. It doesn't always make sense to use tight invalidation, but that's okay because when it makes sense to use wider invalidation, we just size our trade appropriately. So for example, and this is where you guys should really start to understand this concept. Let's say I wanted to trade it like this, okay? My stop loss is up here, 2.82% away. Instead of just to be clear about the position we're talking about here. So instead of trading it like this, which is more how I traded it, and we're going to cover, please pay attention because these concepts are incredibly important. And, you know, I'm going to try to work through them in a way that you guys can understand them, but it's going to take a little bit of paying attention, okay? So I chose to trade it like this. Would it have been reasonable to trade it like this? This is a 3R setup. Certainly. What would this mean if I traded it, you know, this, sorry, this is the setup here. But hold on a second. Let me just pull my stop loss back here so you can see it. I moved it to break even. It's actually going to be really hard to grab. There it is. Okay. All right. If I traded it like this, maybe I say, you know what, I want to short this level, but I think price, you know, I don't want to get chopped around here and I don't want to have to like re-enter or take multiple losses. I'll reevaluate later, but I want to short here and I'll have my stop be up if we come up and take these highs. All right. Then you have to trade this way smaller if you want to maintain uniform risk. I can still risk $4 with a stop way up here. I can risk $4 with a stop here. I just size differently. The reason I would trade some setups tighter is because it's not to get a higher win rate, because I could win 5 of these trades and 1 of these, and it would be better to win 1 of these, right? I could have a much higher win rate trading this way and a much lower win rate trading this way with this particular setup, and it would still be more profitable to size it bigger and run it with tighter invalidation. Not every trade can be run with tight invalidation, but when it makes sense to, it can be a big payoff to doing that. But you have to be wise. You have to know what you're doing. You have to have a system that allows for it, and that stuff I teach in the LATF Discord. But I also teach about running wider stops on some setups, or as a newer trader, You don't need to be trading 18-hour setups to be profitable. Turn this into a 6-hour setup. Relax a little bit. When people are trading tight, they get you can get kind of emotional and that sort of thing. So it's not for everybody, and trying to force those types of setups when they're not there. But this was quite tight. This is quite tight. And so I find myself in this position where I've compounded this trade, and this trade is actually running like it's going to be a 20-hour trade. The only reason it's different on the paper trading account is because I opened and closed it to give these examples. But now I'm going to talk about something. Let me finish this concept here. All right. So there's a big difference. Same entry, but your invalidation dictates the profitability of this trade. If this was my setup, let's just bring it down a little bit more just to make it easier to give the math here. I'd be risking $4. Because again, it's just always $4, always 2%, always uniform risk, 1 to 2% risk. I actually think 2% is quite high for a new, inexperienced trader. I think actually any dollar amount's too high. You need to learn this stuff and put in the time to build your own personal track record, do some paper trading, trade with a very small amount of funds. And the reason is trading isn't just about technical analysis. There's so many other components to trading, and you have to figure out what kind of trader you are, where your strengths, where your weaknesses, the psychological hurdles you need to overcome. But anyways, I digress. I'm risking 2% here. This means for every dollar I risk, I make $3. So if this trade works, I make $12. If it works with the tighter setup, I make $55. $12, $55. But the risk is the same, even with the higher invalidation, because I'm using a system with uniform risk. And uniform risk means that in every single trade, it's always the either 1% or 2%. It could be a mix of both. No matter what the setup looks like, all I know is my entry, my target, my invalidation, and it could be a 3-hour trade, it could be a 20-hour trade, it could be a 10-hour trade. The risk is always the same. The invalidation is always technical. This setup calls for a tighter stop loss in my view, because the setup has given a trigger, the sweep, the retest, and we can get into that short with a stop above the high. It doesn't mean it's going to win. It doesn't mean that what can happen sometimes is I get stopped out and then the trade works. If I'd run the tighter stop, that trade would have worked, the wider stop. But the problem is it doesn't matter, because if I always run the wider stop, then sometimes this happens on this style of setup, and I don't care about the outcome of individual trades. I care about the efficiency and the profitability of a series of trades. So if I'm going to take 20 trades and I'm going to lose an extra 3 trades because I ran a 20-hour setup instead of a 3-hour setup, I don't care, because I'm wildly more profitable, even with the extra few losses, trading these setups efficiently. So I'd rather take the stop with this tighter setup. This is run arbitrarily wide in my view. All right? But there's some more concepts here. We're going to get into some advanced stuff, and hopefully this bridges the gap for a lot of you guys. What you'll see so often on Twitter is people will say, I shorted the top, price came up here, they shorted the top, and their setup looks like this. They risk $1, they make $1. Their setup is so wide that it's essentially, I don't even know how to explain how, in my view, I don't want to say dumb, because dumb isn't the right word. It's so inefficient. Like if I have my short looking like this, which I do, I also have a swing short from the highs, right? I have a short from here, a short from here. I've compounded another short. And also I'm taking longs. I was just in longs. So I understand the market doesn't move straight up and down. So I'm taking longs, I'm taking shorts. If I can trade this like this, say they've traded it like this, they've made a 2-hour setup. And people do this, or maybe they put it above 54K, it's a 4-hour setup. But if I trade my trade like this, I make $16, $17 for every dollar I risk. They make $2 for every dollar they risk. One of these trades is worth 8 of these trades. All right. So anyways, the way I like to look at it is this. If I take a 10R win, 10R means my risk reward is 10 to 1. If I take a 10R win, I can take 10 losses straight. And that one win covers 10 losses if I'm using uniform risk, which in my view is the best way for especially new traders to trade and to learn how to trade, because it takes out all the psychological games you play of, oh, this trade's super good. I think it's really going to work, so I'm going to risk $10 instead of $4. And then they take a loss. And then they say, oh, that last trade, it was a big loss. I better even double my risk because I need to make that back. And this next trade will definitely work. And they start spiraling. Your risk stays the same. Your risk stays the same. That doesn't mean your distance to your stop loss stays the same. You have to compensate it by calculating your position size. You need to learn how to do that, and you need to understand that concept. And so the reason I know for a fact that many of you don't understand that concept is because what this is, well, there's a lot of reasons, frankly. Although I do want to think about compounding this trade. It doesn't matter. It's a paper trading account. The reason that I think a lot of you don't understand this concept is I will take, and this could be a new member in the members Discord. This could be just people on Twitter. I will literally trade 10R setup into 20R setup into 5R setup into 8R setup, all winners. So I'm essentially, if this is a $200 trading account, see, I'm up $30 right now. If I take a loss, I'll lose $4. Each trade is a $4 risk. I'd be the equivalent of being up $150, so up to $350 in a trading account, maybe in the course of a week. $150 on a $200 account. This is the ratio here. And I'm using this balance again because people, they say that they have such a small account, it's not worth joining the LATF, all that sort of thing. The LATF's $97 a month. I'm at $30 on 3 just reasonable trades, not risking more than 2%. But the point isn't that you should join the LATF and start trying to duplicate the trades I'm taking with a live trading account. I'm pointing out the value here of trading with defined reasonable risk and how quickly you can grow an account, even a $200 account, that a $97 fee versus the value is incredibly low, even on a small trading account, based on the types of principles and ideas and systematic trading ideas that you're going to be learning and exposed to every single day. But the reason I think many people don't understand it is it'd be the equivalent of being up $150, and then I take a trade and somebody says, and it gets stopped out. Let's just say this is my trade. So here, again, I'm taking the same structure of trade. This is my invalidation. If it gets hit, I lose $4, okay? It's a long setup. If my target gets hit, let's just put it here, I make $4 for every dollar I risk. So I'm going to make $16. I risk 4 to make 16 on this $200 paper trading account. I'll take the trade and I'll get stopped out. I'll be on a 120R or even just a 10R, 15R, 20R run. And then I'll get messages like, I thought, what happened to your long? It got stopped out. I thought you thought that price was going to bounce. Freaking out. I mean, some people will be like, I just got absolutely wrecked. How are you getting wrecked? So this trade is 17 losses, right? This trade alone, just closing it here, is 4 losses. This teeny little trade, because of how it's structured with proper invalidation and proper sizing, this trade, closing it right here, there's like 3.5R or whatever the heck it was. Not at the bottom, closing it right here, something like this, it's 5R. That means it's, for every dollar I risked, I made $5. I structure it with uniform risk, so it's $4 risk, right? I hope you guys are following me. I make $5 for every dollar of risk. I've risked $4, so I've made $20 with this risk reward. Here, my stop is wider. Let's just say I want to retest this level with a stop under these lows. That means my position's smaller. It's $4 risk For every dollar I risk, I make $4. So this teeny little move here is more profitable than this big move up because of how the trade is structured. Some setups you just can't reasonably run with super tight stop losses, and some you can. But people will message me saying they got wrecked. Why'd you entered long? Did you get stopped out? What are you doing? Almost in a panic. For one, don't fucking copy trade me and take trades you don't understand. Like, take the time. I'm sorry, but take the time to learn this stuff. All of the content's there. There's people who join even the LATF or follow me on Twitter. I post so much educational content, and people don't go through any of it. And they're trying to trade, and they don't even know what any of this means. They don't know how to structure a trade. They're risking 20, 30, 40, 50% of their accounts with super high leverage. 2% risk. I'm up $30 on a $200 account in 10 hours with just reasonable trades. Never risking more than 2%. But anyways, people freak out over a 1R loss after a 10R win, straight into that, right? And what I think they're doing, and what people fall into the trap of doing, is say they're on a winning streak. They start increasing their risk, right? This is where people talk about euphoria. Mark Douglas has a great series on this. But they start thinking they're invincible in the market. They can't even perceive risk anymore. It's like, whoa, if I just risk twice as much as last time, and if I would just run my stop here or my liquidation here, and this trade works, if I risk 10 times more, I'm going to 500x my account. It's like, that's where things start spiraling. You have discipline, systematic trading. There's no reason to ever be scared or panicking in the market. You can make tons of money. So one of the reasons that I'm so proud of what I'm doing at the LATF and the impact it's having on people's lives are the stories that come out of it. Just the other day, a trader who has been in and out of the LATF for 2 years, but just kind of almost like I think even he referred to it as almost like a gambling addiction, blowing up account after account after account, until he finally, this all sunk in that mathematically, your trading system will never work. And I'm going to end the video with this concept. If you do not understand averages and probabilities over large numbers and the law of large numbers, and if you're taking on too much risk, you will just eventually blow up. It doesn't matter how good your system is, because your account can't handle a small series of losses. But if you're trading with 1 to 2%, yes, if you take 3 losses in a row, it's kind of annoying. That's a 3R loss. It could be 3%. If you're trading with 2% risk, it could be 6%. And I will say, I believe that 2% is high. If you're not a very experienced trader, you do not even need to be risking 2% to grow an account quickly if you know what you're doing. But understanding that risk management, and was able to 500% his account, compounding it in a month, never risking more than 1 to 2% of his account on a single trade, right? I mean, that's life-changing. Consistently trading, he's also scalping. So he's taking, I think he said 10 to 15 trades a day, scalping. He's in and out of that market that frequently, building that much trading history and data in a month, up 500%, never taking more than 1 to 2% risk. So this is what traders do. I do not take a trade because I think I know what will happen. I have zero clue when I take this short if this idea is going to work. But what I do know is that this is a technical setup. I've identified these structures in the market. I've identified these structures, and I know that I get paid 20 to 1, 30 to 1, 40 to 1. Now, if price comes down here and I'm at the charts, I'll have a limit TP set. But if it comes down here, I'm at the charts and there's no strength and we just break down, I will pull my TP. I'll manually TP if there's strength, but I'll give price a chance to just run the level, because sometimes it does. And this could turn into an absolute monster. This trade would be something like $190 for the every dollar for the $4 risk on this account. So this would be between these two trades, if price did continue to break down, $300 off of $8 of risk. All right, $300 off of $8 of risk on the two short positions. But this one's all messed up because I was opening and closing it so many times, so it's way reduced in size. I guess this is time to put in one more concept here. Do not misunderstand what I'm about to tell you, because it could be misapplied. And so I'll give a scenario where it's most likely not to be misapplied. I've captured profits by closing this trade. So really, I'd have this as unrealized profits, but this account balance should still be at $6, and I should just have an extra $7 of unrealized profits here. But I've captured it because I was messing around with this position. I've had people say, oh, I had such a great position, I accidentally closed it. Something like maybe their hedge mode wasn't on. That sucks. I've accidentally closed it. I just closed the whole thing. It was so good. What you could do is just reopen it, because there's no difference than opening it here. I'm going to put my stop loss back where it was, 43117. 43117. Oops. And put my realized profits at risk, $7. That's what I made. It's about 3%. So because I had $7 of unrealized profits, I've captured them. Yes, now my risk is going to look, let's look at what it looks like. Wait. Oh, I definitely typed that in wrong. Okay, wait a second. Let me do this. 43078. How did I do that? 43078. Okay, so I'm risking. Let me just think about this for 1 second. I've done this math completely wrong. I can risk $3 more, sorry, because now I can, because I've added to this. Again, hopefully this isn't confusing anyone, but I can risk $3 more. Why is it putting my stop loss up there? Is this... Okay, let me just... What the shit? Sorry. 43101. Oh, I'm adjusting it down here. I am just a complete idiot. I mean, not really an idiot, but okay. All right. Now I see what's happening. Okay, let's close this. The stop loss, I was typing it in the wrong place. So the stop loss is up here, 43109. And let me just double check, because I keep screwing this up. And my total risk can be $9. Again, I was typing it down here, which was the wrong, I was putting my stop loss distance. All right, so now my risk is $8, but that's offset by the fact I closed the position, quote unquote, early. And okay, again, sorry I kind of got us in the mud there by messing up the numbers, because I don't want you to lose track of what we're doing. But let me just put this target here. So I've put that risk back into my trade, but it's offset by the fact that I closed the trade and took the profits. So I'm literally exactly where I would be had I not closed any of that trade, because of the captured profits. It just, instead of showing unrealized gains turning to neutral, I'm just having a loss, but it's offset by the fact that my account is growing. So you guys should be able to understand that. But what's powerful about that concept is, let's just say that price starts reclaiming this level, and you just say, you know what, I want to close my entire short here. All right, this is another way of compounding a position, or trading with a trend or whatever. You close the entire thing. If price claims the level, you just leave it closed and you look for a new short, and you've captured the entire profits off of this short locally here, which is like, it could be 4 to 5R, which is incredible. You've closed the entire thing. If price comes back up here, you re-short it maybe. and maybe lose 1R of the 4R you made. If price continues to break down, you just reopen the exact same position size, just like this. You put all of those profits back at risk. Doesn't mean you have to let price run all the way up to here. This is just the size. So you have the exact same size you had before you closed, offset by your profits. And if price continues to break down, you hold. If price reclaims again, you can just close it at a tiny loss, right? It could be something like 0.2R, 0.1R, and you wait for higher. If price breaks down, you can reopen. And yes, you might take a few micro losses there, but price usually doesn't do this. It usually picks a direction, and you can keep your entire size because your risk is offset by the fact you took profits. Many times what's going to happen is this is going to allow you to get out of the trade completely. If this happens, you just sit out of it. You wait for weakness. Even if this happens, you can just enter back where you got out, and you're no worse for wear. You've basically lost your fees to open and close the trade. The only thing that happens is psychologically, instead of seeing a green number of realized profits going back to neutral, you're seeing a bigger red number, but it's no different than the green number going back to neutral in this case, because it's just a continuation trade, and your captured profits are offsetting that risk. All right, so let's just talk about probabilities over large numbers really quickly. If I'm flipping a coin, and it can be heads, I don't need to draw this out, but especially because this is terrible. Be heads or tails, but it has a 70% chance to land on heads. I'm always going to bet on heads, no matter what. Heads, 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 heads. Not because I know the next flip will be heads. I just know 70% of the time it will be heads. So if I'm willing to risk $1, if it lands on heads, lose $1 if it lands on tails, I'm going to make money over the long run by betting small, reasonable bets on heads over and over and over and over again. The law of large numbers is going to average those out, but it's also going to give me some loss streaks, some unlikely loss streaks. But you flip the coin long enough, it's going to go on tails 5 times in a row. It's just bound to happen. And that is why, as a trader, you don't bet the house. You don't put everything on one trade. Because if you do that long enough, yes, it might pay off. You might say, okay, 70% to land on heads. I'm going to bet my life savings on the next flip being heads. Why would you do that? You have no idea if it's going to land on heads. That's just being a gambler. But you can guarantee you'll make money. It's a certainty. Essentially, I mean, you'd have to have like winning the lottery bad luck, like 1 in 50 billion. If you just take reasonable bets, flipping that coin over and over and over again, it's going to average out to profit over the long haul. And that's what trading is. But what people will do is they'll bet it all on this trade, or they'll bet it all on this trade. And sometimes it will work, and they'll say, oh my God, I made such a good decision. You know, this is incredible. I've made so much money. They'll do it again, and they'll just lose everything. Or they'll run no stop loss. That'll work for 4 coin flips, and then the 5th coin flip, they just lose everything. But if you just consistently manage your risk, let's say in this case, $4 risk, $4 risk, $4 risk, sometimes I'm going to make $20, and sometimes I'll lose $4. Sometimes I'm going to make $6, and then I'll lose $4. Sometimes I'm going to lose $4, $4, $4, and then I'll make $28. And then sometimes, you get what I'm saying? It's asymmetric risk reward, and it's never taking a bet that's everything, because then that puts you out of the game. So I don't take this trade because I know what's going to happen. I take this trade because it's a technical setup. It's a great coin flip to take. I can put on a reasonable amount of risk, and I can turn $4 into $30. I can turn, or risk $4 rather. So I always think about it in terms of putting on risk, and don't get confused that the distance to your stop loss dictates your risk. If I wanted to short this like this, I could do that. I could short here with a stop above this high. That's still a reasonable setup. It's a 3R setup, but then my position's got to be much smaller. to maintain that risk. I know I'm almost talking in circles at this point, but I hope to leave you guys with this valuable concept in the video that you do not need to take extreme risk to grow an account. This account that I started yesterday, up $30. That's 15% in one day. Well, since last night, it's not even a day. With many of the major targets not hit yet, I could close this trade right now, and I've outperformed the majority of not traders, profitable traders, monthly returns. So profitable traders are already 5% of traders in the market. So 95% aren't profitable. And the vast majority of those are, and there's nothing wrong with this, are doing 5R, 3 to 5R a month, 7R, 8R. So I'm up 10R, 7.5R. Wait. Oh my gosh. I just completely had a brain freeze. I'm up 15%, which again, 15% in a single day, trading with 2% risk. A $200 account to a $230 account, one day. And can you not see the value of joining something like the LATF, learning these concepts, applying them even to a small trading account? Managing your risk, never being fearful in the market. Okay, I got to end this video here. I did not expect it to be this long. Hopefully it's not too rambly.